12 major retailers are falling apart in 2023. Most towns in the U.S. had small shops scattered in every neighborhood. When behemoths like Walmart and Target were granted tax abatements to locate in certain towns, it made it nearly impossible for most stores to compete. Now, in 2023, analysts think many well-known brands are succumbing to the pressures of economic downturns, changing customer behaviors, and financial difficulties, leaving folks with no options. The financial landscape is experiencing a grim reality check. This year is shaping up to be the worst for bankruptcies since the turmoil of 2020, with familiar names vanishing from the market. The decline in foot traffic, especially in urban areas, has dealt a severe blow to the once mighty players. With consumers tightening their purse strings and the specter of a recession looming, the sales graveyard may expand further. The question now is, which brands will be the next to succumb to the unforgiving retail landscape in 2023? We put enormous effort into producing data-driven content to show you what's fake and what's real. Subscribe and comment to The Final Economy. Target. This major giant has been facing a series of difficulties in recent times. The company has been facing a significant number of store closures. These cessations are primarily attributed to substantial losses, notably stemming from rampant shoplifting incidents. Shoplifting has been so severe that it has forced Target to adopt a more cautious approach to the selection of store locations. One noteworthy development is Target's decision to move away from major urban centers and instead focus on smaller towns. This strategic shift is driven by a dual objective: to reduce operational costs and to boost revenue in the face of economic headwinds. The losses incurred by Target due to shoplifting amounted to a staggering $1 billion, significantly impacting the retailer's financial health. As a result, the brand has had to make some tough decisions about its store portfolio. Target is reevaluating its approach and carefully selecting store locations that align with its new strategy. Staples. For years, Staples has faced stiff competition from e-commerce giants, with Amazon being a primary contender. This competition has made it increasingly difficult for Staples to maintain its traditional brick-and-mortar presence. One key factor contributing to the struggles of Staples is the shift in consumer behavior. There is now reduced demand for office supplies through physical stores, and this change is directly translating into declining sales volumes for the company. As a result, Staples has been experiencing a squeeze on its profits, making it challenging to sustain its extensive network of sales locations. Currently, Staples operates over 1,000 stores across the United States. However, faced with declining sales and profitability, the brand has decided to close nearly 200 of these stores in the coming months. This strategic move is part of a broader effort by Staples to reassess its physical store portfolio and adapt to the evolving business landscape. The company's restructuring efforts reflect the broader shifts in consumer behavior and the economic struggles that retailers are currently facing. Amazon Fresh. A branch of the e-commerce giant, Amazon is undergoing a series of store shutdowns, particularly in the third quarter of the year. The decision to close these stores is influenced by several factors. One of the primary reasons behind the closures is related to the format and performance of Amazon Fresh stores. Consumer feedback has highlighted concerns about the quality and pricing of products offered by businesses through the Amazon Fresh format. These challenges have posed difficulties in attracting and retaining customers in an increasingly competitive grocery market. To address these issues, Amazon has made the strategic decision to downsize its Amazon Fresh and convenience stores. This move involves focusing on serving only a select number of markets in the United States and globally. Amazon's decision to close some of its Amazon Fresh stores is part of an ongoing process of optimization. As it continues to grow and evolve in this sector, Amazon aims to identify the locations and features that resonate most effectively with its customers, ensuring a more streamlined and efficient sales experience. Bye Baby. This is a chain specializing in products for infants and young children. Unfortunately, it has reached a critical juncture as its parent brand, Bed Bath & Beyond, has concluded its bankruptcy liquidation process, resulting in the shutting down of all Bye Baby locations. The struggles faced by Bye Baby are indicative of broader trends in the retail industry. The impact of changing consumer behaviors, intensified competition, and economic uncertainties have all played a role in the difficulties faced by the chain. Furthermore, the bankruptcy of the parent brand, Bed Bath & Beyond, added to the complexities of the situation. The closure of Bye Baby stores is a reminder of the harsh realities that many retailers are confronting in these challenging times. Journeys, a well-known retailer specializing in footwear and accessories, is facing a significant challenge, leading to the wrap-up of more than 100 underperforming stores. This decision represents an increase from an earlier estimate of 60 store closures. The primary reason behind Journey's strategic move to close these stores is rooted in a broader effort to restructure its retail business and secure its future. Journeys has been no exception to the evolving consumer preferences and market dynamics. One of the key indicators of Journey's difficulties is a decline in sales. Sales have fallen by 7% in the first quarter and a more substantial 13% in the second quarter of this year. As part of the restructuring strategy, Journeys is pursuing a deliberate exit from mall outlets, which have been associated with high operational costs and a persistent decline in foot traffic in recent years. The decision to close over 100 stores aligns with this strategy and is intended to streamline the brand's operations and improve its financial performance. Big Lots. This well-known discount chain is facing a challenging period, marked by a series of store closures. One significant factor contributing to the shutdown of Big Lots stores is financial pressure stemming from shoplifting and theft. Losses due to theft have had a tangible impact on the company's profitability, making it difficult to sustain operations at underperforming locations. In addition to the financial challenges posed by theft, Big Lots has made the strategic decision to move away from urban centers and refocus its efforts on more rural areas. This shift is motivated by a dual objective: to reduce operational costs associated with urban locations and to target markets where there may be greater demand for discount retail offerings. The decision to close stores in Colorado due to low performance issues earlier in the year underscores Big Lots' commitment to optimizing its brand operations and improving its overall financial health. IKEA. The renowned furniture chain is undergoing a significant transformation marked by a series of store closures. One of the primary drivers behind the wrap-up of some IKEA locations is the need to adapt to changing consumer preferences and market dynamics. The traditional big box format, while iconic, has faced struggles in an evolving retail landscape. To remain agile and responsive to shifting trends, IKEA has decided to move away from these large warehouse stores. The downsizing of IKEA stores is part of a broader strategy to optimize its sales footprint. By moving into smaller premises, IKEA aims to improve its operational efficiency and better serve the evolving needs of its customers. These cessations are not necessarily indicative of a contraction, but rather a transformation of the business experience. Hardee's, the well-known fast food chain, is facing a challenging period marked by financial difficulties that have led to the shutdown of approximately 45 Hardee's restaurants. These closures are a result of the parent company, CKE, filing for Chapter 11 bankruptcy protection. The decision to file for bankruptcy protection was driven by several factors, including a decline in foot traffic, profitability issues, and increased competition within the fast food industry. Additionally, a severe cash flow crisis played a significant role in the brand's decision to seek protection under Chapter 11. The impact of the economic downturn and changing consumer preferences have added to the complexities of Hardee's situation. The struggles in meeting debt service and rental obligations have put further pressure on the chain, necessitating store wrap-ups as part of the bankruptcy proceedings. Corner Bakery, the fast casual cafe chain, is navigating a challenging period marked by financial struggles and the shutdown of a significant number of its locations. These closures are a direct result of the brand filing for bankruptcy. Corner Bakery's financial difficulties have arisen from various factors, including slower returns to offices, particularly in large cities. The challenges facing Corner Bakery also include weaker sales, labor shortages, and financial results that have fallen short of expectations. These factors have made it increasingly difficult for the company to maintain its operations and meet its financial obligations. In response to these struggles, Corner Bakery filed for bankruptcy, and in June it was acquired by callback acquisition for a sum significantly lower than the brand's initial asking price. The new owners have embarked on a strategic restructuring plan, which includes the cessation of 172 locations in the third and fourth quarters of the year. Auntie Anne's, the American franchise chain known for its fresh pretzels and other products such as pizza dips and beverages, is facing a challenging period marked by the shutdown of 116 units, reflecting a decline in sales and a need to adapt to changing market conditions. One of the primary drivers behind the closures is the impact of inflation. The rising costs of ingredients and other operational expenses have forced Auntie Anne's to pass along higher prices to its customers. However, this move has been met with resistance, leading to a significant drop in sales. In 2022, sales collapsed by 23%, and this downward trend has continued into 2023. The cessation affects approximately 18% of the chain's network. This strategic move aims to improve the profitability of Auntie Anne's by streamlining its operations and focusing on locations that demonstrate higher levels of demand and profitability. Boston Market. Formerly known as Boston Chicken, this business is undergoing significant changes, marked by the closure of 52 locations. This move reflects a response to soaring food prices and challenges related to ingredient shortages that have affected the company's profitability. The shortages of ingredients have also compounded Boston Market's difficulties, making some of its stores inoperable. In response to these struggles, the brand is closing 52 locations in the current year, intending to operate 268 restaurants by the end of 2023. This represents a significant reduction from the over 450 Boston market restaurants that existed before the health crisis. This strategic move is part of Boston Market's effort to improve its financial performance by rationalizing its store footprint. Guess. A luxury apparel business is undergoing a significant transformation marked by the closure of 200 branches worldwide. This move includes the shutdown of approximately half of its locations in the United States and is a response to challenging market conditions. The decision to close a substantial number of Guess stores is influenced by several factors, with one of the primary drivers being the impact of inflation. Rising costs have forced the company to adjust its pricing, which has led to a downturn in sales. Additionally, the apparel sector in general has faced a prolonged downturn, further affecting Guess's sales results. The cessation of 200 branches represents about 18% of the brand's network. The decision to downsize and restructure is emblematic of the broader challenges faced by luxury apparel retailers in the current environment. Every business in the market is facing similar conditions due to current circumstances. Only the retailers taking proactive measures and smart planning will be able to survive this financial turmoil. Also, staying informed about current financial conditions will let customers make informed decisions.